So I think we've got Steve Benger on the phone. Steve, are you there with us?
John, I'm here. If you can hear me,
Yeah, great. Good to hear your
great.
voice, man.
Yes,
How's
likewise.
uh how's Chicago this morning?
It's a beautiful day. The sun is shining like yesterday, so it's pretty good. It was a really nice weekend here, actually. It wasn't supposed to be at first, but it turned out really, really nice.
That's
So it's
that's
great.
awesome.
Yeah,
That's
I
awesome.
agree. Yeah,
Man, I can't wait for you to come down and play some golf around here. But
I, I
you
know.
know,
Plus, I need all the tutoring I can get from you, John.
oh my God. Yeah,
As
I've
a
got
former
videos.
professional, right?
Yeah, I've
You
got a
should be able
package of
to
videos
to
you can
teach me a
watch.
couple of tricks.
Okay. Hey, listen, we were talking, this weekend a little bit about what these rate hikes really might affect and the normal course of history of how this, usually pans out in the short term, the long term. I would just love for you to expound on that a little bit if you can this morning.
Sure. Obviously, it's a financial crisis. We basically only one direction in rates, right? So we went down pretty much every day, every
Right.
year, or the whole
Mm-hmm.
time, up until about the December rate hike,
Mm-hmm.
December 2015, December 16th, and that kind of changed the psychology of the markets a little bit. And immediately after the December rate hike, the market went down by roughly 4% within a couple of days. There was the initial rally, but then it kind of had this big downward swoon, two-day action down by 4%.
Right.
And the market rallied back into the end of the year. And then we had the big January swoon, right? When the market went down, when you look at the S&P, about 13% from the top of the range to the bottom of the range throughout January.
Okay.
And that was really the first rate hike we had seen since 2008. And ever since
Isn't that
the
amazing? And when you say that, I mean that sounds so amazing. It took 8 years, you know.
yes,
It's
I agree.
incredible. Yeah,
I
go ahead.
agree. And the Federal Reserve has been adding liquidity ever since, right? So there was the first time that the Federal Reserve really kind of like tightened liquidity, at least as it relates to the official rates. Um, and I think it kind of changed the psychology of the market a little bit, or actually quite a bit. And since then, we have had three FOMC meetings which showed no results, right? And every time but one, subsequently to those FOMC meetings, the market sold off again. I mean, the January meeting, the market had a three-day rally, but then it fell 6%. The April meeting, the market went down about 3% within 7 days. And really, the only FMC meeting where there wasn't a lot of action subsequently was the March meeting. And I think that presents a really interesting opportunity because if you believe that the psychology of the market has changed, that the FOMC is not the provider of good news anymore, then the June meeting represents a really good opportunity to short the market for a couple of reasons. First of all, we are running into the presidential election cycle, and there's not going to be any rate hikes later this year anymore. The stated goal of the Federal Reserve was to raise rates in 2016. And depending upon who you listen to, the bets were on that we're going to see either two or three rate hikes. And if you take any of those things at face value and look at the more recent hawkish data, for instance, the housing stats last week were the strongest housing stats in 8 years, then I think there's a really good chance we're going to see another rate hike in the June meeting. And if you look back at how the market reacted to the December rate hike and how it just didn't take the more recent FOMC meetings as good news, I think it sets up a really interesting short opportunity.
So, what would be the strategy to possibly take advantage of that? I mean, I understand everything you just said. It's extremely valid, and I think everybody out there really, it's great for them to hear that. But as a timing tool, what kind of macro strategy maybe could be taken to try to, maybe take advantage of that concept, in your
If the
opinion?
Yeah, so if the market rallies into the before the FOMC meeting or rallies into the FOMC
Hmm.
meeting, I think there would be really good opportunity to start accumulating puts.
Okay.
Um, and if the market's just sideways, not going anywhere, you might take a gamble and wait for the FOMC meeting, hoping that the market's going to pop to the upside. And if you get a 1 day pop or even perhaps a 2 day pop, start buying puts. Um, So that would be my strategy. If the market just kind of like sideways, trades sideways into the FOMC meeting, if you like to risk it, accumulate puts while it is in the sideways period. But if I'm right, the market is gonna swoon to the downside. And
Right.
just judging by the last or three out of the last four FOMC meetings, there should be quite a bit of downside pressure, because even the one where the market didn't have a lot of downside pressure, which was the March 16th meeting,
Hmm.
the market pretty much went sideways. It didn't really shot up. So,
Right.
and there was an opportunity to get out because there was like a 1%, 1.5% give back to the downside subsequently. But I think you want to be short into the meeting and sure enough after the meeting.
Right. Critical thought processes there. What, so it wouldn't be something really complicated. I mean, the market's going up, the VIX is kind of, pulling back in that type of scenario, volatility is kind of contracting. You're just thinking, maybe buying some puts out of the money, kind of buffering through any type of spikes that might happen and just
Yeah.
keeping it simple, basically not getting too complicated with the strategy.
Yes, I would agree with that. I mean, um, if you only play for, let's call it a 3% downward move, 4% downward move, which is what we had immediately after the December 16th meeting and the January meeting and the April meeting, I mean, you kind of have to stay with like at the money with your S&P puts, or buy
Hmm.
some VIX calls. If you play for a bigger move, you can be a little bit out of the money.
Right.
But I believe the key is that the recent history has shown that the FOMC did not generate a pop to the upside.
Right.
So, disregarding the initial pop after the meeting.
Right.
But so consequently, it seems to be a low risk, high reward opportunity, because if the trade doesn't really work out that great, the market should not be blasting to the upside subsequently.
Right. Yeah, I've talked about last time we talked, we were talking about, volatility contraction before this. I think we were around, I want to say 2040 or something last time we talked. And we had talked about maybe kind of buying some volatility play, and now we're up 60 points since then, pretty
Yes.
quickly. So that was interesting to talk. Can you stay on for a little bit longer?
Sure, I'm
All right,
around for a
thanks.
couple of minutes.
We'll,
All right,
we'll be right back, guys.
all right, perfect.
Okay.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit tfnn.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the show. We've got Steve Benger on with us. And, Steve, I never really introduced you properly at the beginning of the show. I was just thinking about that. Steve is he was a Merck member. Actually had a clearing firm. At one point, you sold to Revco, right?
Yes, that's correct. Went to
Right
Revco.
back. Yeah. And that was back. Well, when was that? That was back in the early 2000s.
Yeah, that's a long time ago, right? I mean, the firm kind of like went to Revco late 2001, early 2002.
Okay.
So, and I mean, I
met you right after that, and you were generally happy all the time after that. I remember.
Yeah, I could speak at length about that, but I won't, because as with everything in life, right, there is a flip side to every story.
Right.
But yeah. So I've been in that business for a long time. I used to be a member of pretty much all of the major exchanges, starting all the way back to Eurex, Live, so the 2 big European futures exchanges, and then the US here, the CME, Board of Trade, mostly electronic memberships, Cantor Fitzgerald, all of that stuff.
Cool. Well, I tell you what, can we switch to currencies for a little bit, because it might relate to some of the things we talked about earlier, as far as rate hikes and situations like that.
Yeah, I just want to say one thing as it relates to volatility and where the market is right now, because I want to make sure that it's being put into proper context.
Okay.
The market is obviously right now at its all-time high, give or take it, right? I mean, you're in striking distance of making new historical highs here. Mm-hmm. And a significant breakout above that with a closing on a weekly basis about the old highs would certainly signal that we're going to have another couple of percentage points to go to the upside. So in a perfect world, that happens before the FOMC, the June FOMC meeting. So that is kind of like off the table. But if the FOMC meeting propels the market into new higher grounds with a close, everything I said before is kind of off the table. You don't want to be short at that point. So if the FOMC actually produces a close into new historical high grounds, you don't want to be short.
Right. Yeah. So I totally hear what you're saying. That's good historical, been there, done that information when it comes to looking at these breakouts before announcements or breakouts after the announcements. Invaluable. Can we talk about the some of the currencies next?
Sure.
Okay. On the euro, let's just go right to the main one here. How does that? I mean, because of the upcoming, the FOMC meeting, the possibility of rate hike, whether the broad U.S. equities markets does what it does either way. Do you see the euro revisiting lower inflection points, or do you think this thing's just going to be just kind of churning around and kind of a wait and see, attitude? What's your thoughts on that one?
Well,
and I guess the dollar, the dollar's looking this morning is I don't know if you've looked at it, but we talked about this 95, 60, 50 general area on the dollar. And now we've kind of talked about not really looking at that as a shorting opportunity. It's top of the profile on the weekly. It's kind of edging up, looking a little bit stronger. How does that factor in, you think?
So the last time I was on, I mentioned the fact that the U.S. stock market, in my view, is basically the tallest of all the midgets right now, right? Meaning that the European stocks in general are doing much worse than American stocks, and Asian stocks in general are doing much worse than American stocks. So we're doing much, much better than everybody else. At the time, I think the last time I said that the Euro Stocks index was down something like 24% from its historical high, whereas we are only down 2%. Or at the time, we were only down 2% versus our historical high. So capital flows go to where there is the safest harbor, and that is undoubtedly still the United States. And on some level, that is still the case, and that is what has been propelling the stock market upwards. And I don't see this trend breaking anytime soon. Europe is fighting deflation, and we are, on some level at least, trying to adjust our monetary policy to a more reasonable inflation expectation. So we look much better for any type of currency speculator than the euro does. So the dollar should be stronger and should remain stronger than the euro, just given our basic fundamental scenario.
Right. You know what always astonishes me when I go over to Europe, and I haven't been to Germany in years. God, when was the last time I was in Germany?
You're missing out, John.
Over probably 10 years.
Right.
Whenever I'm over there, Steve, I get this feeling it's just a lot stickier, muddier, more cumbersome to really do business over there. That's my. I just get. I mean, I was in London maybe 6 months ago, and it feels like the business environment is opening up more, but it still feels red tape-ish. If you know what I mean.
Yes, I mean, on some level, there's a reason. Well, first of all,
that's my opinion.
You're right. You're right. Depending upon where you are in Europe, that's definitely the case. Because just think about it. I want to say like 15, 16 years ago, French, if you take the two European powerhouses, French and German GDP per capita was pretty much in line, was pretty much the same number. Nowadays, German GDP is about 40% greater than French GDP per capita. So the reason why that has happened is undoubtedly because Germany has done a better job of deregulating the economy, making things easier, which then provided an environment for faster economic growth. So depending upon where you are in Europe, I think what you just said makes perfect sense. I mean, there's definitely more regulation in some countries versus other ones. And that, of course, then generates a competitive disadvantage or benefit depending upon where you are.
Do you think, we got about a minute left, and I really appreciate your time this morning. What do you think about the Brexit situation? Do you think that's kind of water over the bridge? It's not anything to worry about, or for the currency market, anything to worry about anymore? It's pretty much in the bag as far as them not exiting, or what do you think?
I don't know. I mean, the problem with the Brexit is that if it were to happen, it might very well be an earthquake in the financial markets because it might signal the end of the European Union as we know it. I think there's a lot at stake here. So The
And that
latest
wouldn't
polls,
necessarily probably be a bad thing for like the Germanys of the world, which are kind of towing the line more than anybody else, right?
well, I actually think would be a bad thing for
Over the
Germany.
long term, maybe.
No, I actually think it would be a bad thing for Germany.
Okay.
Because
Okay.
if you think about it, right, I mean, the only reason why Germany is doing better than everybody else, once again, comes from the midgets. They're the tallest midget among the
Right.
European countries.
Right. Well,
Right?
Steve,
I mean,
look,
that's really-
thanks for coming on today. We got another break, and I really appreciate your
All right.
time.
I
Thanks,
need to
Steve
go
Benger,
anyhow.
folks. We'll be
All
back.
right. Thank you, John.
Yep.